stars. For some signposts, we turn to Mitch Goldberg, president of his own investment firm, Client First Strategy. Mitch, welcome. Good to have you with us.
Thank you for having me.
You know, we in financial news on television, we are very partial to telling people exactly what to buy. Tell me what to buy, and I get it. We're probably less good at telling people what and when to sell. What's your best advice for them?
My best advice is investors need more discipline because you're right. People are always focusing on what to buy. Research is buy-driven. But as investors, we need to take some chips off the table. As they say, don't count your chickens until the eggs hatch. So, don't count your profits until you take something off the table. My feeling is that with a disciplined strategy, I like to use strategies like stop orders, trailing stop orders. But basically, I want it pre-programmed so that when my stocks go up a certain amount, let's say you have 1,000 shares of a stock, it's up 25%. I want to take 25% of my shares off the table and reinvest the proceeds.
So you take the emotion out of it, basically.
As much as possible.
Mm-hmm. And, you have some tips. We have them up on our screen, so let's go over some of them. You say hesitation is the costliest enemy from investors. Is that to the emotion thing that Tyler was just talking about or something else?
No, it goes directly to the heart of what Tyler was talking about. When you have hesitation, it's a symptom of a lack of a disciplined strategy. So what we want to do is we want to bring in the discipline to avoid having to, let's say, be in a stock that's up, you ride it up, you ride it down, you ride it up, and then at the end of the day, you really haven't made anything on your equity position.
Are you saying the day that I buy the stock, I pay $20 for a stock, and that day I should say, and when it hits 40 or 50 or whatever it is, I'm going to sell it? Is that the discipline?
It's somewhat similar. There is a little bit of feel to this also because it depends on industry, volatility, different stocks, different news coming out. But typically, if I'm up 25% in a stock or so, that's where I'm going to look to put a stop order just below that level. So
you say don't sell all at once. That's the other point here. In other words, if the stock has gone up 25%, you might not dump 100% of it, you might dump 25 or 50%. Similarly, if let's say I bought a stock, for argument's sake, or an ETF at $100 a share, I ought to have in my head the point at which I am going to start aggressively selling on the downside, right?
Yes.
Is it only price-driven here, or do I want to watch developments in the news if I hear that an earnings number isn't good or that there's some sea change in an industry? Or those kinds of day-to-day news factlets probably going to mislead you as much as they're going to help you?
I would say they're going to mislead you as much, if not more, because then what's happening is you're becoming so hyper-focused on the day-to-day news. You start buying, you start selling, but you're not really making any progress. There is something called buying and giving investment some time and being patient. So if you're going to, let's say, buy a stock, for example, I'm not necessarily going to buy it all at once. I might put even, dare I say, a market order for 25% of a new position and put a buy limited order in for the same stock. If it goes down 3%, I'll double up. If it goes down 6%, I'll buy a little bit more.
It's a buy limit order.
Right.
It's an open order that basically says that you're willing to pay a specific price at a certain price or lower.
Mitch, I was really interested on this last tip that you have for our viewers. You're saying raising cash is not a long-term strategy. How do you know how much cash you should have in your portfolio?
It's a good question. I think generally it speaks to people's risk tolerance, their time horizon, their financial goals. But if somebody is, let's say, 70 plus, retired, I'm actually looking to be maybe 40 to 50%
that much
cash and fixed income. I am. Things can change a little bit, but right off the bat, at this level of the market, that's where I'm comfortable for my clients. Again, everyone's situation is different. Somebody in their 40s or 50s, we're probably talking 10 to 15% cash.
So I think we began very quickly. We began by saying you're taking a few chips off the table. Where? What kinds of stocks? And what are the characteristics of the ones you're selling?
Well, the characteristics of the ones that I am mostly selling are actually my winners. And they are across the gamut, from industrials to consumer discretion, consumer staples, healthcare, energy.
Well, I'm glad to hear you have winners across the gamut. That's a good thing.
Well,
in your business.
The idea is to thank you very much. Yes, we have our share of bruises also. Okay.
All right. So you're selling the winners, not the losers.
Right, but it's a gradual process of coming out of old positions gradually on the way up.
Yep.
and taking on new positions on the way down. So it's always a seesaw between cash and equity.
Well,
Mitch,
that's
thank you very much.
fascinating.
Mitch Goldberg of Client First Strategy.
Thank you
Thanks
for
again.
having me.